What if the biggest threat to America isn't a sudden economic crash? What if it's something much quieter? A slower economy, a weaker labor market, persistent inflation. Yas expensive borrowing, and a government carrying an enormous debt burden. At first glance, America doesn't look like a country on the verge of collapse. Businesses are still operating, millions of Americans are working, financial markets are functioning, and the economy is still growing. But beneath those headline numbers, something important is changing. Several warning signs are appearing at the same time. And that raises a much more important question than simply asking whether America is collapsing. The real question is this: how much economic pressure can the United States absorb before its options begin to disappear? Because the danger may not be an overnight collapse, it could be a slow squeeze. And that story begins with growth. For years, the American economy has repeatedly demonstrated an extraordinary ability to recover from shocks. But economic strength isn't measured only by whether GDP is positive. It's also measured by how quickly the economy is expanding and how much momentum it has behind it. Recent growth has slowed. That doesn't mean recession is guaranteed. It doesn't even mean the economy is contracting. But slower growth matters because it gives the economy less room to absorb another major shock. Think of it like a vehicle climbing a hill. The vehicle may still be moving forward, but if its speed keeps falling, another obstacle becomes much more difficult to overcome. That's the concern facing policymakers. If growth slows while inflation remains elevated, the Federal Reserve has fewer easy choices, and that leads directly to the next warning sign: the labor market. For ordinary Americans, economic statistics eventually become personal. They become a job, a paycheck, a promotion, or the inability to find work. Recent employment data has shown signs of weakening. Job growth has disappointed, and previous employment figures have been revised lower. The unemployment rate alone doesn't tell the entire story. Why? Because the unemployment rate depends partly on who is actively looking for work. If people stop searching for jobs, they can leave the labor force without appearing as unemployed. That means economists often have to examine several indicators together: hiring, participation, wage growth, job openings, and revisions to previous employment numbers. None of this proves that America's labor market has collapsed. It doesn't. But it does suggest that one of the economy's strongest pillars may be losing some strength. And that matters because American consumers remain the engine of economic activity. If households begin pulling back, the consequences can spread quickly. Walk into an American supermarket and the economic debate suddenly becomes very simple. Look at the prices, look at the mortgage payment, look at the utility bill, look at the credit card balance. Even when inflation slows, prices don't automatically return to where they were years earlier. That distinction is crucial. Lower inflation means prices are rising more slowly. It does not necessarily mean prices are falling. For millions of households, that creates a continuing financial squeeze, and housing makes the problem even more complicated. High mortgage rates can make buying a home significantly more expensive. Higher borrowing costs can also affect businesses. When consumers spend less, businesses can face weaker revenue. When businesses face weaker revenue, hiring decisions can change. And when hiring weakens, household confidence can fall further. This creates a potential economic feedback loop. But there is another institution sitting directly in the middle of this problem: the Federal Reserve. The Federal Reserve has one of the hardest jobs in the American economy. It has to balance two major risks: inflation that remains too high and an economy that becomes too weak. If the Fed keeps interest rates higher, borrowing becomes more expensive. Mortgages cost more. Business financing becomes more expensive. Consumers may delay major purchases. But if the Fed cuts rates too aggressively while inflation remains persistent, demand could strengthen again, and inflation could become harder to control. That creates a difficult balancing act. Imagine trying to slow a car without stopping it completely. Too little pressure, and the car keeps moving too fast. Too much pressure, and you risk bringing the system to a halt. The Federal Reserve is constantly trying to find that middle ground, but America's problem isn't only monetary policy. There is another massive pressure building in the background: government debt. America's debt is not a new problem. For decades, the United States has borrowed to finance government spending, and debt by itself does not automatically cause economic collapse. The United States has enormous economic resources, it has deep financial markets, it has a massive tax base, and the dollar plays a central role in global finance. So why worry? Because debt becomes increasingly difficult when interest costs rise and deficits remain large. The government must continually finance existing obligations while also paying for current spending. And when borrowing costs rise, servicing that debt becomes more expensive. That can create a difficult cycle. More debt can mean more interest costs. More interest costs can mean greater pressure on the budget, and greater budget pressure can make future decisions even harder. This doesn't mean America is about to default. That is not what the evidence shows. But it does mean fiscal flexibility matters. And that's where interest costs become extremely important. Imagine the federal budget as a giant household budget. If more and more of your income goes toward paying interest on existing debt, you have less money available for everything else. The federal government operates on a vastly larger scale, but the basic pressure is similar. When interest costs rise, policymakers have fewer choices. They can raise revenue, they can reduce spending, they can borrow more, or they can accept difficult trade-offs. Every option comes with political and economic consequences, and the situation becomes more complicated if economic growth slows at the same time. That's why the debt debate isn't simply about one number. It's about the relationship between debt, economic growth, interest rates, and government revenue. If the economy grows faster than the cost of borrowing, the burden can become more manageable. But if borrowing costs remain high while growth weakens, the pressure can increase. And there is another problem that complicates the Federal Reserve's decisions: inflation. Inflation is one of those economic problems that can become easy to misunderstand. When inflation falls, many people assume prices are returning to normal. Usually, they aren't. What changes is the speed at which prices increase. That means households can still feel pressure even when inflation is dramatically lower than its peak. And for the Federal Reserve, inflation above its target creates a difficult choice. Policymakers want price stability, but they also don't want to unnecessarily weaken employment and economic growth. This is why inflation remains one of the most important variables in the entire story. Because if inflation remains stubborn, interest rates may have to stay higher for longer. And if rates stay higher for longer, debt becomes more expensive. Mortgages remain expensive. Business investment can slow. And consumers can become more cautious. But there is another force that could put additional pressure on prices: trade policy. America is deeply connected to the global economy. Goods cross borders. Factories depend on international supply chains. Businesses import components. Consumers buy products connected to production networks stretching across multiple countries. That means changes in tariffs and trade policy can have complicated consequences. Tariffs can protect certain domestic industries. They can also increase costs for companies that rely on imported materials or components. Businesses then have choices. They can absorb the cost. They can find another supplier. They can reduce margins. Or they can pass some of the cost on to consumers. The final economic effect depends on how companies, consumers, and trading partners respond. So tariffs do not automatically cause an economic crisis, but they can become another pressure point, especially if inflation is already difficult to control. And nowhere is America's affordability problem more visible than housing. For many Americans, housing is the single biggest financial decision they will ever make, and mortgage rates can dramatically change that decision. A house that looks affordable at one interest rate can become far more expensive when borrowing costs rise. That affects first-time buyers. It affects families trying to move. It affects construction. And it can influence consumer confidence. The housing market also connects to the broader financial system. Banks lend money. Builders employ workers. Homeowners build wealth. Consumers use housing equity, so when housing becomes less affordable, the impact can spread beyond real estate. But there is another question. What happens if consumers begin spending less across the economy? Because consumer spending represents a huge part of American economic activity. And that brings us to one of the most important potential feedback loops in the entire story. Imagine a chain reaction. A household becomes worried about the future, so it delays buying a car. Maybe it postpones a vacation. Maybe it spends less at restaurants. Maybe it delays purchasing furniture or electronics. One household doing that doesn't change the economy. Millions of households doing it can. Businesses see weaker demand. Revenue slows. Companies reconsider expansion. Hiring slows. Some businesses reduce costs. Workers become more cautious. And cautious workers spend less. That can create a negative feedback loop. But we need to be precise. This is a risk scenario. It is not proof that America is currently entering such a cycle, and that's an important distinction, because the American economy still has enormous strengths. In fact, those strengths may be exactly what prevents the warning signs from becoming something much worse. The collapse narrative leaves out something important. America remains an extraordinarily powerful economic system. It has a massive consumer market, deep capital markets, world-leading technology companies, advanced manufacturing, energy resources, a highly productive business sector, and the U.S. dollar remains central to international finance. These advantages matter. They give the United States tools that many other economies simply don't have. America has also repeatedly demonstrated the ability to recover from severe shocks. So the question isn't whether the United States has weaknesses. It clearly does. The question is whether its strengths remain powerful enough to absorb those weaknesses. And that depends heavily on what happens next. Because economic crises rarely come from one problem alone. They usually emerge when multiple vulnerabilities collide. A serious economic crisis would likely require something more than slow growth or high debt alone. It could involve a combination of shocks: a sharp deterioration in employment, a renewed inflation surge, a major financial market disruption, a severe geopolitical event, a disorderly debt market situation, or a sudden collapse in consumer and business confidence. None of these outcomes is guaranteed, and predicting an exact crisis trigger is impossible. But economists watch these pressure points because the danger increases when several appear simultaneously. That's the key idea. One warning light isn't necessarily a disaster. Two warning lights may still be manageable, but if multiple systems begin flashing at the same time, policymakers have a much harder problem. And this brings us to the central question behind the entire story. Is America actually approaching collapse? Or is something more subtle happening? Maybe the word collapse is actually the wrong word, because America's greatest economic danger may not look like a dramatic financial apocalypse. It may look much more ordinary. Higher borrowing costs, slower growth, persistent inflation, more expensive housing, rising government interest costs, weaker hiring, and fewer easy choices for policymakers. One problem can make another problem harder to solve. That's what makes a slow squeeze so dangerous. There may be no single day when everything suddenly breaks. Instead, economic flexibility can gradually disappear. The good news is that none of this means collapse is inevitable. The United States still possesses enormous economic strengths, but ignoring the warning signs would be a mistake. And that leaves us with the most important question of all. What happens if the next major shock arrives when America's economic room to maneuver is already smaller than it used to be? So, is the United States on the brink of collapse? The evidence does not prove that. America is not currently confirmed to be experiencing an economic collapse. The economy is still functioning. GDP is still positive. Millions of Americans are still employed. Financial markets remain operational, and the United States retains enormous economic advantages. But that doesn't mean there is nothing to worry about. The warning signs are real. Growth has slowed. Employment has shown signs of weakness. Inflation remains above the Federal Reserve's target. Borrowing costs remain significant. Housing affordability is a major challenge. And America's debt burden creates long-term fiscal pressure. The real story isn't that America is suddenly falling apart. It's that the margin for error may be getting smaller. And when a country carries enormous debt while dealing with inflation, expensive credit, and slower growth, the next major shock matters enormously. That's the truth behind the sensational headlines. Not guaranteed collapse, not guaranteed recession, but a system facing a complicated set of pressures that deserves serious attention. So the question isn't, is America collapsing today? The better question is, how much pressure can America absorb, and what happens when the next shock arrives? If you want more fact-based analysis of the forces reshaping the American economy, subscribe to the channel and stay with us, because the next major economic move may reveal whether these warning signs were temporary or the beginning of something much bigger.